As we look ahead to Tesla's earnings for the first quarter of 2023, there's an air of excitement and curiosity. Tesla has set some high expectations with its deliveries and production numbers, but the ultimate question is whether they will surpass these expectations in Q1. In this video, we're going to dive deep into predictions about Tesla's performance, including stock price forecasts, revenue estimates, net income projections, and what all of this means for Tesla's stock trajectory. So fasten your seatbelts, smash that like button, and let's dive in. In Q1 of 2023, Tesla exceeded expectations by delivering approximately 423,000 vehicles. While this number was slightly below the original estimate of 433,000, it is still an extraordinary achievement. Moreover, the company produced over 440,000 vehicles during the quarter, though production was slightly impacted by a 2-week shutdown of the Model 3 production line. Had it not been for this shutdown, production could have reached nearly 470,000 vehicles, which is a remarkable figure. With these numbers in mind, the question remains, will Tesla outperform its Q1 earnings expectations? In order to answer that, let's take a look at the Tesla stock price prediction chart, which includes several key metrics for each quarter. The first row of the chart shows vehicle deliveries for each quarter, while the second row is dedicated to full self-driving (FSD) sales, which contribute significantly to Tesla's revenue. Each FSD package is priced at $15,000, though there are plans to increase this to $17,000 later in the year depending on market conditions. For simplicity, we are assuming that around 15% of Tesla buyers will opt for the one-time FSD payment. The profit margin from FSD sales is estimated to be between 4% and 5% for each quarter, adding a steady stream of revenue. Additionally, the average selling price, ASP, for each Tesla vehicle in Q1 is expected to be around $50,000, though this figure will fluctuate slightly in the following quarters. In Q2, the ASP is projected to decrease slightly to $49,000, but it will then rise back to $50,000 in Q3. By Q4, it's expected to reach $51,000 due to the introduction of the highly anticipated Cybertruck, which is expected to start at $55,000 per vehicle. Tesla also benefits from credits, which are projected to amount to approximately $400 million in Q1, gradually decreasing in the subsequent quarters, with estimates of $350 million, $300 million, and $250 million for Q2, Q3, and Q4, respectively. Another key factor in Tesla's revenue model is its energy business, which has become an increasingly important revenue source. In 2022, Tesla's energy division generated nearly $4 billion in total revenue, with $300 million in profits. For Q1 2023, I'm predicting that Tesla's energy division will generate approximately $1.5 billion in revenue, with incremental growth of about $200 million per quarter. By Q4 2023, energy revenue is expected to reach $2.2 billion, with profits consistently holding around 12% across all 4 quarters. Of course, one additional factor affecting Tesla's costs is the FX, foreign exchange, expense. As Tesla operates globally, there are costs associated with converting currencies, which are expected to total $350 million in Q1, increasing slightly each quarter. By Q4, this will rise to $375 million. These expenses should be factored into the overall projections. Now let's dive into the predictions for Q1 revenue and earnings. With 423,000 vehicles delivered in Q1, the estimated total revenue from vehicle sales alone is expected to exceed $21 billion. Given the 14% operating margin, Tesla's total revenue for Q1 2023 could be nearing $24 billion when factoring in FSD and energy sales, as well as profits from other sources. The estimated net income for Q1 is around $3.6 billion, which results in an earnings per share, EPS, of $1.13. The consensus from Wall Street analysts, however, is that Tesla's EPS will come in at just 85 cents, I find this figure puzzling, as even if operating margins were reduced to 10%, the EPS should still exceed 85 cents, and my projection of 14% is more realistic. This discrepancy highlights that despite price cuts, Tesla's profit margins are still solid, especially when considering the uncertain economic environment. Looking forward to Q2, my predictions are relatively conservative. I expect Tesla to deliver 444,000 vehicles, which would generate close to $25 billion in revenue. However, due to the lower operating margin, net income will likely fall below $3.6 billion, which would give an EPS of around $1.12. This would bring the total EPS for the first half of the year to approximately $4.40. Moving into Q3, I'm anticipating a more robust delivery figure of 465,000 vehicles, though there is potential for closer to 480,000. This would bring in around $26.5 billion in revenue and net income of over $3.8 billion, resulting in an EPS of $1.17. As we approach Q4, my estimate is that Tesla will deliver 490,000 vehicles, which would bring in nearly $28.6 billion in revenue. Net income could exceed $4.5 billion, and the EPS for the quarter would be around $1.26. This would give Tesla a total EPS of $4.62 for the year, representing a year-over-year earnings growth of approximately 16 to 18%. While the growth in earnings is relatively modest, the increase in vehicle deliveries, a projected 39% growth, is impressive. Now let's explore what all of this means for Tesla's stock price. As of now, Tesla stock is trading between $180 and $190 per share. Given the recent price cuts and some market jitters, the stock price could potentially dip lower in the near term. However, assuming a price-to-earnings P/E ratio of 50, the stock price could rise to $201 per share in Q1, assuming Tesla meets or exceeds earnings expectations. If the EPS falls short of expectations and the P/E ratio drops to 45, the stock price could fall to $161 per share. If market conditions turn bearish and the P/E ratio drops to 30, Tesla's stock price could drop even further to around $101 per share. On the flip side, if Tesla surprises the market with an EPS of $1.13, the P/E ratio could increase to as high as 55 or even 60. While such a dramatic increase in P/E is unlikely in the current market environment, it's not entirely impossible. A higher P/E would indicate that investors are willing to pay a premium for Tesla's future growth potential, which would result in a higher stock price. Given this, I'm sticking with a conservative P/E estimate of 50 for Q1, which would result in a stock price around $201 per share. Moving into Q2, I expect the stock price to be slightly lower than Q1, suggesting that the market may be pricing in some potential negative news. If Tesla fails to surpass Q1's earnings, the stock could see a drop to as low as $161 per share, depending on the P/E ratio. However, if Tesla's fundamentals remain strong and the P/E ratio improves, the stock could stabilize or even rise slightly. With a P/E ratio of 50, I estimate the stock price could be around $226 per share by the end of Q2. For Q3, I'm predicting continued improvement in Tesla's stock price, assuming the company continues to execute well. A P/E of 50 would result in a stock price of approximately $226 per share, though if the market turns more bullish, a P/E ratio of 60 could push the stock price up to $271 per share. In contrast, if bearish sentiment takes hold and the P/E ratio falls to 40 or 45, the stock price could dip to around $180 per share. Looking ahead to Q4, I believe that the market will enter a bullish phase, as Tesla is expected to see solid growth. If the P/E ratio rises to 60, we could see a stock price of $277 per share by the end of the year. To be on the safe side, I'm projecting a more conservative P/E ratio of 50, which would result in a stock price of around $231 per share. While these predictions aren't set in stone, they represent what I believe are realistic price ranges for Tesla by the end of 2023. If the stock price drops below $200, I personally plan to buy more shares. However, if the stock price rises above $300, I will stop purchasing shares in order to diversify my investments. I believe in spreading my investments across various assets, as I'm also saving for a property. It's important not to put all your eggs in one basket, especially when planning for long-term goals. From my perspective, the current dip in Tesla stock represents a buying opportunity. While the stock market can be unpredictable in the short term, I believe that Tesla's long-term prospects remain strong. In 5 or 10 years, I might look back and regret not buying more shares when the stock was still trading below the $1 trillion market cap threshold. However, this is just my opinion, and it's possible that the stock could drop even further, or it may not grow at all. Only time will tell. I have a lot of faith in Elon Musk and the Tesla team. Their mission to accelerate the world's transition to sustainable energy is ambitious, but they are fully committed to achieving it. For instance, they're planning to build a gigafactory in Mexico to produce a new compact car, which could propel them to the next level. From there, they plan to build additional factories around the world, which could ultimately make Tesla the leader in vehicle deliveries, surpassing even Toyota. However, if you plan to need your investment capital in the next year or two, investing in Tesla may not be the best option, as the stock can be quite volatile. Always be sure to do your own research and approach investment advice with a healthy level of skepticism. That's all for today's video. If you found it helpful, please consider giving it a thumbs up and subscribing to my channel for more updates. Thanks for watching, and I'll see you in the next video.